Hello, I'm Ani Chitale. Welcome to our presentation of a topic that is of paramount importance to the future of the fund industry and the Main Street investors it serves. We depend on the fund industry to help us grow our savings. We pay the industry for all the help it gives us. It's only fair. But how much is fair? Since the market crash of 2008, most of us are feeling that the industry is taking us to Las Vegas with our own money and the trip costs are very high. To say it politely, the Main Street is crying foul, but the industry is very powerful. No wonder that lately the mutual fund industry versus the Main Street investors is a favorite topic in the financial media. Now, let's see what's going on between the fund industry and the Main Street. Can you find the individual investor in this picture? Doesn't it feel like a kid's puzzle? Find the puppy lost in the forest and you win a prize? Surrounding the investor are service providers such as fund companies, brokers, custodians, advisors, 401k administrators, and the list goes on and on and on. You will realize that the industry is very lucrative and is also extremely powerful. It services millions of investors and collects billions of dollars each year in fees and costs from them. As of 2014, mutual fund investments total trillions of dollars and the number keeps increasing each year. It's no exaggeration that the financial future of Main Street depends to a large extent on the fund industry. Most investors don't realize that there is inherent conflict between their goals and those of the industry. The service providers are guaranteed fees and costs in return for their services, but the investors cannot be guaranteed returns. That's the fundamental nature of the market. The Main Street investors are getting frustrated with this situation. They are tired of paying high fees and costs for getting mediocre returns. They are unhappy with the ineffective investment guidance provided by the fund industry. However, since the last few years, technology and competition are catalyzing major changes. Innovative solutions are being offered by way of new products and services. The fund industry is facing three major challenges. They are performance-based fees, effective investor guidance, and investor empowerment. As these three challenges get addressed over the next decade, a win-win world could evolve for both the fund industry and investors. Now, let's think about challenge number one, performance-based fees. The performance-based fee structure is fundamentally different from the current fee structure. Currently, the industry charges a simple fee by bundling the fee for trading and accounting with the fee for managing our money. And the bundle fee is made proportional to our assets managed. The service providers with this arrangement can get their fees irrespective of the returns they give us. So to make more money, the industry simply has to raise fees or collect more assets to manage. There is no relationship of the bundle fee with the returns delivered to an investor. In contrast, a performance-based fee will depend on the returns delivered to the investor. It consists of a flat fee and a variable fee. The fixed flat fee is for providing the services of trading, custody, accounting, etc., and this can be calculated easily. The variable fee is proportional to investment performance. It could be calculated, just as an example, by way of return and its minimum value relative to the market, There could even be some measurable risk limit. Performance based fees could provide an incentive for service providers to focus on performance and put client goals first. And in return, they could get more satisfied customers. So, why would the industry change its current bundled asset based fee structure to a variable performance based fee structure? The answer is simple. It's because the industry is under pressure to reduce fees and costs, and because investors are waking up. Several years back, some traditional advisors were charging 5% per year of assets managed. Now, traditional fees are around 2% to 1% or even less. And fees have come down to even less than a quarter percent with robotic advisors. Actively managed funds are also facing pressure to reduce fees and expenses. Index funds and ETFs with inherently low fees and expenses are rapidly becoming more popular. So, with this scenario, how would the industry adopt a variable fee structure? Well, as the current bundle fees reach close to the cost of doing business, service providers will unbundle them. They will create new flexible fee structures and new products to attract more customers. The change has already begun. A few RIAs are already charging a separate fixed fee for custody, trading, and accounting, and a variable fee for their investment advice. They are competing more on performance and less on image. They are putting client goals first ahead of their business goals. Recent articles in RIA Biz, an electronic newsletter, illustrate this awakening. The articles are about the client first philosophy of an Arkansas advisory firm and about President Obama's talk to advisors. The articles point out that putting client interests ahead of their own interests can actually help business growth. Now, let's explore the next big challenge of effective investor guidance. Guidance is necessary to help investors make good decisions. All kinds of guidance are available through thousands of sources, and advisors have their own views and interpretations on which funds they believe are well managed. Investors can easily get drowned with all this data and information. The big questions are, how effective is this guidance? And which guidance is effective and which is not? Effective guidance can empower investors to take charge and manage their own investments if they want to. Effective guidance can also help advisors deliver better performance to their clients. It's obvious that, on the other hand, outdated guidance can confuse and hurt investors. Effective guidance consists of education in advanced investment know-how and the information that is necessary to apply the know-how. The guidance process has two phases. The first phase of guidance is about long-term financial planning for life. Most financial planners are relatively well equipped to do this planning work. The next phase is the investment phase, when the plan is actually implemented and changed from time to time. In this phase, an investment portfolio is created to match the client's risk return needs, and the portfolio is rebalanced as the market changes over time. Two critical problems occur in this investment phase. Simply put, they are: use of obsolete investment know-how, and use of inaccurate and misleading information. Here's an example of the first problem. The industry typically gives know-how in the form of rules of thumb that don't really work anymore. The industry tells investors that high returns require taking high risk. Yet, research of more than 25,000 fund symbols over the last 15 years conducted by investment risk management systems shows that this is not only incorrect but is damaging to investors. Recent research by Robert G. Ibbotson, Emeritus Professor in the Practice of Finance at the Yale School of Management, and Daniel Kim, Research Director at Zebra Capital, also suggests that lower risk, lower volatility stock portfolios give higher returns. And here's an example of misleading information, the second problem. This is just one example. The industry shows fund performance as past returns over 1, 3, 5, and 10 years, and ratings that are based on past performance and these annual returns. And investors use them to choose the funds they would like to invest in. But the regulators, including SEC and FINRA, warn investors that past returns don't guarantee future performance. Even the rating companies clearly state that their ratings should not be used to predict future performance. The ratings are simply awards for past performance of funds. So how can the ratings be useful to make investment decisions? It's an industry secret that fund companies and brokers don't use the ratings and data that they give to Main Street for their own investment decisions. Digging a bit deeper, we find that the rating companies draw a huge amount of their revenue from licensing the ratings to fund companies and brokers, who in turn use them to showcase past outperformers. Now, this clearly shows that there is huge potential for conflict of interest between the industry and the Main Street. The guidance and ratings problem is very complicated and damaging to investors. There is plenty of evidence that the guidance provided by the industry is ineffective. Mr. David Swenson wrote an article about this in the New York Times. He is the well-known manager of Yale University's endowment fund. He emphasized that millions of mutual fund investors lose billions of dollars each year by making bad investment decisions. He pointed out that the blame squarely falls on fund rating companies and the herd behavior of investors who chase past returns. Fund companies and brokers are not sure how effective performance measures and ratings can help their business growth. The ratings might show that some funds are not good investment choices. Also, if fund companies and brokers claim effectiveness of their know-how and performance measures, they could become vulnerable to all kinds of lawsuits. For fund companies and brokers, it is safer and cheaper to continue providing what has been traditionally accepted for generations than to risk providing truly advanced know-how and information. But an awakening is beginning on Main Street. Astute investors are realizing that guidance in the form of past returns, with the disclaimer that past returns are no guarantee of future returns, is worthless and insulting. Many innovative advisors are now realizing the need for advanced methods of managing portfolios and better information. Yet, it is a common belief amongst investors and advisors that investing is an art. Yes, it is an art. But investment decisions also require know-how and accurate data that can make the difference between good and bad decisions. Now, this is science. Without science, buying funds would be like gambling in Las Vegas. Think of an airline pilot. A pilot can master the art of flying through practice and experience. But the pilot cannot ignore the many gauges on the dashboard, and the instruments better be accurate. Would you want to fly on an airplane flown by a pilot who flies by the seat of his pants and ignores the gauges on the dashboard? Investors are now asking, if traditional guidance is so confusing, then what guidance should we use? The answer is that they should use guidance systems that are based on the most recent advanced investment know-how. Wall Street and fund companies have it, but they won't disclose it. Yet the secrets are slowly reaching Main Street. That's the power of technology-driven competition. At the center of advanced investment know-how is the accurate application of proven Nobel laureate concepts of modern portfolio theory and efficient frontier. The basis of these concepts is not prediction. There is more focus on managing risk to get expected reward. Major Wall Street brokers measure risk very carefully and use it as the central thesis to manage their own firm's money. According to MPT, efficient portfolios give higher returns with higher risk. I am repeating the words efficient portfolios. For a given level of risk, an efficient portfolio will have the maximum possible expected return. This applies only to efficient portfolios. Now, this theory worked very well in efficient stable markets. But today's global markets are highly uncertain and unstable, and not all portfolios are efficient. Generally, mutual funds or even ETFs lie below the efficient frontier. This means that for a given risk level, a fund might have lower returns than those of many other funds at the same risk level. This opens the opportunity to select the highest return funds for different risk levels. So, to create an investment portfolio based on MPT, one must balance the expected reward and risk. So, is the optimal balance suited to each investor's individual needs. An interesting presentation by a well-respected MIT researcher comes to mind. I attended Dr. Andrew Lowe's presentation at a seminar organized for MIT alumni. The heading of his presentation was, "All the Lies That My Professor Taught Me." And the interesting thing was that his professor, Nobel laureate Dr. Robert Merton, was also on the panel of speakers. Dr. Lowe explained his latest research. Why traditional rules of thumb about asset allocation and risk-return optimization following the theory worked well in the past, and why they don't really work in the current unstable and highly uncertain markets. He pointed out how the theory could work well by using dynamic risk-return optimization in today's markets. But it's very difficult for Main Street investors to implement. Of course, This also opens the door for innovations that make it easy to implement dynamic risk return optimization. More and more advisors have begun focusing on risk management and rigorously applying modern portfolio theory for portfolio optimization. Now, here is an example. Mr. Bruce Fleet is the founder and president of Fleet Capital Management in Washington State. Throughout his career of more than 30 years, he has been interested in teaching investors and advisors the fundamentals of effective portfolio management. He focuses on managing portfolio risk for his clients, and his clients are the best advocates of his disciplined approach. Here are Mr. Fleet's views on risk return optimization in his advisory practice.
I think it takes time in the industry to really learn the fundamentals, funny enough. One of the main lessons that I've learned over the last 3 decades of managing client portfolios is that you really can't manage returns. Returns are given to us. They're provided to us from things that are beyond our individual control. Returns are functions of the U.S. and global economics, geopolitical activities, and commodity price swings. That is not something that we can manage. But on the other side of the coin is risk. And risk can be categorized, as there are many different types of risk. Risk can be quantified, it can be measured, and therefore it can be managed. Because anything that can be managed, or measured rather, can be managed. Now, as it pertains to the mutual fund industry and mutual fund investments, there are thousands and thousands of investment choices out there for both advisors and investors. And let's say hypothetically that 10% of all of those managers out there provide above average rates of return or below average risk. So when we start with that 10% of the industry and we narrow that list down, that can still be hundreds, if not thousands, of investment choices. So we need to narrow down our focus even further for the best choices of investments for our clients. One methodology for doing that is using things like Sharpe ratio, which of course is how much return we're generating per unit of risk. And that's been very, very helpful to use through the years. Another technique I've used in the past is called information ratio, which is the standard deviation of alpha or excess return. And we use that technique to weed out the managers who have had one fantastic year, but then the other years are just mediocre, because that can skew results. And what we're doing, and what most advisors are looking for, are the managers who provide both a better than average return along with reducing volatility or risk. One final tool that I've used before I talk about my relationship with FundReveal is a scatter plot. A scatter plot is simply used to highlight those managers who are in the northwest quadrant, as we call it, which means they're providing a better rate of return with lower risk. But the fallacy of that is that that snapshot is just one piece of current time. So my attraction to FundReveal is that it takes that analysis, the managers in the northwest quadrant, to a whole new level by measuring the consistency of a manager's ability to remain in that category of above average returns at below average risk. And to date, I have not seen any other tool available to advisors or investors that really can measure the worth of a manager by the consistency, by how consistent they are, that they can almost predict into the future that they have the ability to continue that above average return with below average risk. So that's what I've been focusing on for the last 30 years now.
We requested Mr. Fleet to throw further light on the usefulness of simultaneously providing both the average daily return and the volatility of daily returns, so that advisors can choose the right kind of mix of mutual funds for their clients. And we also asked him about the value of more frequent portfolio rebalancing in the unstable and uncertain markets that we are facing today. So here is Mr. Fleet's response.
The great advisors out there, the really talented advisors, understand that our industry and our work is a combination of both art and science. The science is one of the tools that FundReveal is providing us. It's providing us the raw data. It's showing us the consistency of a manager's ability to achieve certain results. But the art side of what we do is matching that with the client expectations and the client risk tolerances based on behavioral finance. And so just because an investment has a good Sharpe ratio, it may have very high volatility. And that may, in fact, not be the best thing for a client. So again, it's that combination we have to take advantage of, providing that it's a good job and a good portfolio for both our client and the investment portfolio as a whole.
The third big challenge is investor empowerment. It is connected with the second challenge of effective guidance, but it's not exactly the same. When effective guidance is provided to investors, it can empower them to take charge of their financial health. A proverb highlights what empowerment is all about. Give a man a fish and you feed him for the day. Teach a man to fish and you feed him for a lifetime. Taking this analogy a bit further, if a man is taught the wrong way to fish, it will keep him hungry for his lifetime, not just one day. About 20 million investors depend on traditional advisors and RIAs, including new robotic advisors. Investors who use advisors are generally not interested in advanced investment know-how. Now about 70 million DIY investors manage their own investments of about $11 trillion. They include people with $9 trillion invested in 401k type retirement accounts. But DIY investors who should be interested in learning the right way of making investment decisions are generally oblivious. They continue using obsolete rules of thumb propagated by the industry since the buttonwood tree days of the beginnings of Wall Street. Yet many investors have become frustrated and pessimistic. They get returns lower than or almost the same as that of the market, while the riskiness of their portfolios is higher than that of the market. They are now waking up to reality. Lately, many DIY investors are showing interest in learning how to invest successfully. That means they are willing to spend time in that learning. The old days of investors blindly trusting advisors and fund companies based on image and relationships are almost over. Investors are asking probing questions to advisors and fund companies. How do you know and measure the quality of a fund manager's decisions? How can I be assured of good future returns without taking undue risk? The big questions are, how can investors get advanced investment know-how? Who will provide it? Who will empower them? Innovative players are now addressing these questions. They are exploring different ways of empowering investors with advanced investment know-how. Here are just a few examples. Innovations in more accurate measurement systems and automated tools for dynamic risk-return balancing are beginning to be offered to investors and advisors. they can make effective use of modern portfolio theory. Many advisors have begun using these advanced tools for managing risk and also educating clients on how modern portfolio theory is accurately applied to manage risk. It is helping them attract and retain more clients. Now, many universities have e-learning websites. They have an excellent opportunity to add investment education in these websites, and this could benefit millions of investors. The universities could make more money and also enhance their image. Most importantly, a new profession is taking root. It is about investment coaching and not advising. And there is a big difference between coaching and advising. These new services are independent of fund companies, brokers, and advisors. They simply provide the latest know-how and objective information to empower DIY investors who can then make their own investment decisions and trade through their own brokers. These Main Street services are becoming attractive to professionals who save through their employers' 401k plans or have IRAs or other brokerage accounts. So, to summarize, in our view, the mutual fund industry is currently facing three challenges: performance-based fees, effective investor guidance, and investor empowerment. As these challenges get addressed over the next decade, a win-win world could evolve both for the fund industry and the Main Street. And that is our view. We hope that the debate continues. Everyone will be winners, the Main Street and also the fund industry. We welcome your questions and comments. Here's how you can reach us. Thank you very much.